So, kind of talk about the markets a little bit here. Kind of a interesting week. We had retail sales come out, and tomorrow we got the Fed and all that good stuff. And not only that, we have kind of a lot of contract rollovers as well. We in the futures markets, if you don't know, this Friday is what they call quadruple witching day. That's where futures expire, options on the futures expire, options on equities expire, and single stock futures expire. So you'll hear it called quadruple witching day. Sometimes you'll hear it triple witching day, whichever it is. There it is. But about a week before then, they will roll those futures contracts over to the next one, just so they don't get hung in what they're currently in. And so in the S&P, well, then that's the chart you're seeing here on my screen. On the left side is the June contract, which is the one that is now what we rolled over to. The one on the right side is the March contract, which is the one that's going to be expiring this Friday. And you'll notice the charts look virtually identical. It's still the S&P, right? But the prices are quite a bit differently. You'll notice on the right side, we're at 56.15 on the S&P, and on the left side, we're trading at 56.66. So basically, we're a 50 points difference between the two contracts, even though the charts look the same. And once we get into that rollover kind of stuff, they have to kind of reconcile between them, saying, well, we're the front month now, but we still have this other one going on. And one thing I thought was really interesting yesterday, if you look at the March contract, let me just kind of pull this out a little bit. You'll notice this. Let me get my little pen here so you can see a little bit better. This red bar right here, that was Monday's high last week. And I mean, we've already been selling off and everything like that, but they really kind of plunged this one down right here. So when we start looking at that, we sit there and think, well, what's kind of going on in here and this, that, and the other. And so they pull this thing down. Of course, they kind of bottomed out down in here, and then they started ricocheting it. One thing that was really interesting down here in this area is basically your 10% retracement from this high up here. So if you took that high, which was basically 61.66, took 10% off of it, puts you right down around 55 and 55.50. And that's basically where they kind of nosedive down to, and you kind of see they bounced off of it 3 or 4 times before they kind of started bouncing back up. And so all of a sudden we come into this week, which is these two bars right here, which now this one, even though it's the quote unquote front month, they've all the trading volume has shifted over to the June contract. And I'll show you why I'm pulling this up. This high, by the way, right here, that little high right there on that March contract where we started out last week's high, was up at 57.75. And so if you kind of keep that in your brain real quickly, and then clear all these little drawing things back out here. I'll just pull this back over. You'll notice yesterday, which was the day that we kind of rolled over, and so everything had a nice big rally yesterday, right? Everybody was like, oh, look, we're going up, we're going up, we're going up. Well, the high of this bar from yesterday on the June contract went up to 57.59, basically right up to last week's high of the March contract. And now they went up to last week's high on the June contract for March. They hit that and they were just like, okay, now we kind of put everything back to where we were in, for the March contract on June. And now they can start moving this thing around where they want to. And so they kind of started out basically where March started out last week, put the June contract there and said, there, now we can start going where we want. And it's kind of weird when they roll over what point that they'll try to, bring things back to. A lot of times when we have such a big premium between the two contracts, one will either sell off to the other one, or the other one will rally up to where the other one was, and so on and so forth. But I always kind of like watching that rollover day just to see where they take it. And basically, that's where they took it. They took the last week's high. I mean, then they all of a sudden today, what happens? We start selling it off, right? So now we continue our current trend, which right now we are in a downtrend. Things are definitely weaker rather than stronger. And so now the question is the downside really over, or is the upside, um, you know, you know, this is just a little rally, false rally before they kind of roll things back over again. Who knows? But we'll be patient and watch and wait and kind of find out. Right now, they're arguing to the downside rather to the upside. They hadn't taken out yesterday's low yet. They've come really close. Um, so we went down to a low of what was it, 56.51 yesterday, and we went down to 56.51 today, and so we're basically um, hitting the same spot we hit yesterday before they started taking off and rallying. And so do we take out yesterday's low, which is the week low, right? And do we continue to move lower, or do they correct this thing back saying, hey, we hit last week's high on the March contract? Then they kind of flip things back around and go from there. And that's where we're in kind of a catch-two situation. Oh, guess what? Tomorrow's the Fed. How about that? So they might be just pulling this thing back to see what the Fed's going to do. And right now, the argument is they're not going to do anything. But the data is starting to weaken up a little bit. And so we'll see if, um, you know, they try to, get a little spurt up in this rally or this market, or do we go out and just get below the 10% correction low? And usually it's 10 to 12% when they correct the market. We got in that range a little bit, and they've been trying to hold it the best they can. So right now, I think we get past tomorrow, we'll probably have a better feel for what this market's going to do. So, but that's just the difference between the two contracts. And now that they got their yah-yahs out, we'll see what the Fed does tomorrow and see how the markets end up from there. Another thing that's been kind of cool here uh, is good old gold. Um, ta-da! On a rally, making new all-time highs. There it is. And you'll notice they had a lot of resistance right up here at this 2970. They finally busted it, and they started scooting up, and they hit that 3,000 mark. And the first time they really hit 3,000, they did it overnight. And and then they kind of yanked it back. And now they got above 3,000. They closed above it, and now they've kind of spurted up here today. As you can see, we're up here at 30.47. Usually when they hit these century marks and stuff like that, they kind of back things up a little bit. But I think there's so much right now uncertainty in the markets. People are going over to something that's more safe, if you will. And so they're pouring into the gold market. And so right now, the argument is who cares? We're above 3,000. Now, the big question is if they correct this thing back down, do they go down and retag 3,000 again and hold support there, right? Or do they bust it and kind of correct down? If you watch to see what gold does when it hits these different marks, it'll usually correct back anywhere between 60 to 150 points. And it'll shake a lot of people out, and everybody gets all flustered and worried and everything like that. And all of a sudden it turns back around and just takes off again. And yesterday when we kind of closed, I was just like, well, okay, they closed above 3,000, but I'll probably wake up in the morning, we're back down to 2980 or something like that. Came in this morning, we were at 3040. So I was just like, well, they took off. How about that? So I'm anxious now to kind of see if we do get a correction. Again, tomorrow's Fed day. So we'll see what the indexes and gold does based off what Noel Powell says. Most of the time, he puts his foot in his mouth somehow. And it kind of shakes the markets up a little bit. So even though the 2 o'clock news tomorrow is, do they cut rates, leave rates the same, blah, blah, blah. The big thing is the press conference that comes in after that. We get to actually hear what he's thinking and what he's going to say and this, that, and the other. So it'll be really interesting to kind of see which way that goes right now. And but that's kind of what I'm looking for. And we kind of step back and start looking at what they're doing in the administration and stuff like that. I think one thing that I've been kind of keeping an eye on and is really uh, the aerospace defense market. Um, we, I mean, everybody says, okay, we're trying to get Ukraine shut down in peace and blah 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 blah. Yeah, I think the same thing with the Gaza Strip and everything like that between Israel and Hamas. They're trying to calm all that down. Okay, fine. Um, but we still sell arms to places. I mean, we just you know, we're going to sell more arms over to Ukraine and everything like that. So these defense guys are still going to be doing pretty well. And even outside of that, if you look at what they've been saying, they're going to start rebuilding the military and all the guns and the tanks and the blah 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 blahs and everything like that. So I still think the defense industry is still going to end up doing pretty well. And here we are over here, bombing. Who was it? What was the name of that country over there? Anyway, I almost want to say Qatar, but it's not Qatar. Amman or whatever it is. Anyway, so we're over here droning them to death, and so we're going to still need more of our defense. And I think we're going to be building defense, and I think we're going to continue. Yemen, thank you very much, Jim. I appreciate that. I knew you'd tell me. My brain went clunk. So, um, but that's the biggest thing. And so when we start looking at the defense sector of things, instead of just trying to pick one that's out there and everything like that, I think what would be kind of a smart move. Um, there we go. And you can see this thing chews and chops around and stuff like that. This is ITA. This is the Aerospace Defense ETF. And you can kind of see we've been having a nice little rally over the past couple weeks. And I think this thing has the potential really to really take off and run on a longer term basis. Now, if you want to buy the stock, that's fine, but it's a $150 stock. So, but one thing that I would encourage you to look at um, would be maybe getting into like a 153, 163 bull call spread that expires in July. Um, and if you look at that, you might change that up a little bit. Always look at, and this is what I look at when I look at a call spread. I never like to pay more than half the spread in any spread that I buy. So on a $10 wide spread, you don't pay more than $5 for it, right? On a $15 wide spread, you never pay more than $7.50. On a $20 wide spread, you never pay more than $10. Well, if you look at the 153, 163, it's going for right just shy of $5 right now. But if you move that out from the 153 to like the 166 or 168, I guess it is, um, you'll notice that, yeah, you'll still pay around $6 for it. Now, I can pay $5 for a 5 wide spread, or I can pay $6 for a 10 wide spread. That's not bad. And even if you want to go from a 153 to a 175, you probably can pick that up, and that's a 20 wide spread. You might be able to get that for about $6.50, which you make more bang for your buck, right? That's what my point is here. I mean, I can make $5 on a 5 wide spread. I can make, on a 10 wide spread, I can pick up about a 15 wide spread, I can pick up about $9. But if I go to a 20 wide spread, I could pick up somewhere around $1,300. Even though it's further out, it's not costing me but another dollar or two for making that much more money. That's my point. So depending on which one you like the best, I'd look at a 10 wide, 15 wide, and 20 wide. Now, what's really weird, I think once they get above $70, they'll do $5 strikes. So you can't do a $1 strike like it is over the next 20 points or next 15 points up. So just beware of that. But I would I myself am in a $20 widespread. I just bought it. And so expecting this thing to continue to move higher. Now we're going to have some resistance up around 160, as you can see on this chart here. But I think this thing has the potential to move a whole lot higher if they start, getting the Defense Department to put out more orders to start bringing in more things. And I think we'll see, the defense industry, and you're going to have ups and downs throughout this whole time. Nothing ever goes straight up. Okay. But I think if you can get out to July, and if you want to go, out to September, I guess that'd be fine too. But I'd look for like anywhere between 10 to 20 wide spread on this thing, because you get more bang for your buck that way, and just kind of pack it in the back of your portfolio and check on it once every couple weeks. And if you're up $20 this week and up $40 the next week and up $80 the next week, hey, you're still making money on it. Just let it go. And I think this thing will continue to kind of push on higher a little bit. And you can see we had this big shot up here at the very beginning of the year. Then they kind of waned off a little bit when the tariffs and everything like that started getting really talked about. Okay. This is, basically the inauguration area right here. They shoot it around, they dumped it off. And it's been kind of going back and forth since then. I think once the tariff thing kind of gets out of the way, and of course he's set, the 2nd of April to be, the big tariff day. But we'll just kind of see how that kind of filters out through the markets and everything like that. They already know they already knew it was going to happen before he even got, inaugurated. Now that he's doing it, the market's all of a sudden surprised. So, yes, and I'll agree with that, Dave. I mean, you can do a smaller spread on it, and you have a higher probability, and kind of go from there. But I mean, I just kind of look at things as long term. The thing is, um, when you look at just buying an outright call, that's 4 or 5 months out, you're going to pay $800, $900 for it. And I thought, well, you could do a 20 wide spread and pay less than that. So instead of doing an outright call and paying a whole lot more, why not decrease it and put a 20 wide spread on it? Even if it only goes up 10 or $15, you're still going to make quite a bit of money. You'll decay the short call that's out there, and the long call is going to be up quite a bit. So as we go further, um, but oh, Darla, the ticker's ITA. I think I can click over here, and there we go. Yeah, the ticker's ITA. But it's something that I've got, packed into my portfolio and stuff like that, just expecting a run out of the defense industry. And we'll kind of see if it pans out or not. I think it will over time. But there's a lot of things I just kind of get out and study about and everything like that, and really don't look at it as a short-term deal. If you want to try to do short-term stuff, go for it. I think this is just kind of a longer term as the orders and everything like that start panning out, and they get the money out of this one and throw it into that one, and so on and so forth. I think we'll kind of see this continue to move back up. So, but anyway, if you all have any questions, let me know. Otherwise, we'll see what the Fed does tomorrow. I think that's going to kind of tell us what gold and the S&P is going to be doing. Just kind of sit back and kind of watch and wait for that, kind of see what he has to say. When we get back together on Thursday, we'll have a better idea of what's going on, and then maybe have a little clearer picture of where this market wants to kind of head as we round out the first quarter of the year. So, but anyway, with that, we'll kind of wrap things up here. And can you cash out early? Oh yeah, absolutely. You can cash it out anytime. If you're buying something, you can sell it at any time. Absolutely. I mean, yeah, you can. I mean, like I said, if you get into like a 153, 170, let's just chunk that out there. If it runs up to 165 or something like that over the next 2 weeks, why not cash out? Take the money and run. Absolutely. I mean, there's nothing wrong with that. So I just gave it more time. I mean, you have to remember when you're buying options, you're going to get time decay. So the longer you put on there, the less time decay you're going to get. And I mean, if you're putting 4 months on the thing, I know I can hold on to it for two months anyway and not have that much time decay out of the thing and kind of see what this thing does. That's the one thing that's really nice about it. Um, silver, same thing with silver. The one thing I really want on silver, Liberty, um, is I'd really like for it to get above 35 bucks. I mean, if you look at copper right now, it's pushing against $5 right this second. And silver, it's seeing $35 and it's taking some nice Polaroids of it and it's going, oh, look at that. And then a beautiful number, um, which I don't like it doing that. I'd rather for it just to pop above 35 bucks and then kind of start moving up again. I think that's its next big level. And as long as gold is pushing up and copper's pushing up, I don't see how it can't. So I think it's just resisting at 35 bucks right now. And once it gets above $35, it'll definitely go. But you have to remember, no, silver has a tendency of outperforming gold. And silver's had a huge run. I mean, you're talking about something that's moved up $5 from 30 to $35. And granted, gold's moved from 2750 up to 3000. So both of them have had a pretty good little run here. But I still want to see silver above 35 bucks. If it'll do that, I think it has room to run. I think it'll run up to at least 37 and a half, 38 area before it starts kind of slowing down again. Um, of course, that's going to be pushing gold above, 31, 3200 once it gets there. So I don't see whether there's any, no, gold's not going to be going down anytime soon. I think there's too much uncertainty out there and a lot of people trying to hide, and if the dollar continues to move down like it has been, more people are going to be moving into gold and silver. So what amount of impact with the quarterly options expirations? Is there a way to analyze it? This is quadruple witching. Well, it's really funny. A lot of people think that options expiration day is a down day. I've seen a lot of up days and option expiration day. I mean, now we have no options expiring every month, every week, heck, every day. I mean, we have 0 DTE options now. And DTE means no days to expiration. But they have literally every kind of option you can shake a stick at anymore. And I don't think, options expiration day, quote unquote, has a real big impact on the market so much anymore because we got options expiring all the time. You go back, ways where we only had monthly options, it was a big deal. Then they started making weekly options, and it was still kind of a big deal. Now we have just no options expiring all the time. So I don't know. I don't put a lot of emphasis on expiration day. The one thing I will say is, as far as futures are concerned, when we get the ding 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 at 9:30 in the morning Eastern, the March contract is no longer with us, and we just have the June contracts at this point in time in the index futures. So that being said, they don't have something dragging them around or anything like that. They're free to go wherever they want to go. But as far as options on equities and stuff like that, it's just going to be like any other Friday of the month, really. So, but anyway, but let's kind of see what the Fed does tomorrow. We'll come back again on Thursday. We'll put our heads together and kind of see what this market's trying to do or trying to tell us, and we'll go from there.